Hello and welcome to Active Finance YouTube channel. What is the money market? The money market is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities with average maturities of 1 year or less. It enables governments, banks, and other large institutions to sell short-term securities to fund their short-term cash flow needs. Money markets also allow individual investors to invest small amounts of money in a low-risk setting. Some of the instruments traded in the money market include Treasury bills, certificates of deposit, commercial paper, federal funds, bills of exchange, and short-term mortgage-backed securities and asset-backed securities. Functions of the money market. The money market contributes to the economic stability and development of a country by providing short-term liquidity to governments, commercial banks, and other large organizations. Investors with excess money that they do not need can invest it in the money market and earn interest. Here are the main functions of the money market. 1. Financing trade. The money market provides financing to local and international traders who are in urgent need of short-term funds. It provides a facility to discount bills of exchange, and this provides immediate financing to pay for goods and services. International traders benefit from the acceptance houses and discount markets. The money market also makes funds available for other units of the economy such as agriculture and small-scale industries. 2. Central bank policies. The central bank is responsible for guiding the monetary policy of a country and taking measures to ensure a healthy financial system. Through the money market, the central bank can perform its policy-making function efficiently. 3. Growth of industries. The money market provides an easy avenue where businesses can obtain short-term loans to finance their working capital needs. Due to the large volume of transactions, businesses may experience cash shortages related to buying raw materials, paying employees, or meeting other short-term expenses. Through commercial paper and finance bills, they can easily borrow money on a short-term basis. 4. Commercial bank self-sufficiency. The money market provides commercial banks with a ready market where they can invest their excess reserves and earn interest while maintaining liquidity. The short-term investments such as bills of exchange can easily be converted to cash to support customer withdrawals. Also, when faced with liquidity problems, they can borrow from the money market on a short-term basis as an alternative to borrowing from the central bank. The advantage of this is that the money market may charge lower interest rates on short-term loans than the central bank typically does. Types of instruments traded in the money market. Several financial instruments are created for short-term lending and borrowing in the money market. They include 1. Treasury bills. Treasury bills are considered the safest instruments since they are issued with a full guarantee by the government. They are issued by the government Treasury regularly to refinance Treasury bills reaching maturity and to finance the federal government's deficits. They come with a maturity of 1, 3, 6, or 12 months. 2. Certificate of deposit, CD. A certificate of deposit, CD, is issued directly by a commercial bank, but it can be purchased through brokerage firms. It comes with a maturity date ranging from 3 months to 5 years and can be issued in any denomination. 3. Commercial paper. Commercial paper is an unsecured loan issued by large institutions or corporations to finance short-term cash flow needs, such as inventory and accounts payables. It is issued at a discount, with the difference between the price and face value of the commercial paper being the profit to the investor. Only institutions with a high credit rating can issue commercial paper, and it is therefore considered a safe investment. 4. Banker's acceptance. A banker's acceptance is a form of short-term debt that is issued by a firm but guaranteed by a bank. It is created by a drawer, providing the bearer the rights to the money indicated on its face at a specified date. It is often used in international trade because of the benefits to both the drawer and the bearer. The holder of the acceptance may decide to sell it on a secondary market, and investors can profit from the short-term investment. The maturity date usually lies between 1 month and 6 months from the issuing date. 5. Repurchase agreements. A repurchase agreement, repo, is a short-term form of borrowing that involves selling a security with an agreement to repurchase it at a higher price at a later date. It commonly used by dealers in government securities who sell Treasury bills to a lender and agree to repurchase them at an agreed price at a later date. The Federal Reserve buys repurchase agreements as a way of regulating the money supply and bank reserves. The agreement's date of maturity ranges from overnight to 30 days or more. If you have any question, kindly drop in comment box.